There is an implicit cost associated with the use of financial leverage. That cost is higher risk. So we've been talking about how using financial leverage, or effectively other people's money, sometimes we call it OPM, but using other people's money in the form of financial leverage or debt can amplify returns. And so it can increase the BTIRRE and the ATIRRE, the before tax and the after tax internal rate of return on equity. But there is an implicit cost associated with this use of financial leverage, and that is higher risk. So that means that the decision to use leverage cannot be made by only looking at these before tax internal rates of return on the total investment in the property or on equity. Instead, the investor needs to ask whether the higher expected return that comes with that leverage is commensurate or is appropriate given the higher risk that the investor is going to have to take on because of that leverage. So the investor should also ask, is there a way to realize that higher return without taking on so much risk or taking on less risk? And so the one way to do this is to do a scenario analysis. And so one thing that finance students should keep in mind is that a lot of what we're talking about is the same type of analysis that we would do with just traditional finance when we're looking at potential capital projects in which we might invest. The only thing that's different here is that we're specifically applying those techniques to real estate. And so in capital budgeting, we would often conduct scenario analysis where we would think about, well, if this scenario happened or that scenario happened, and then we consider the probabilities of these different scenarios. Well, in this particular case, when we're thinking about these implicit costs related to financial leverage, we would do the same type of exercise, and we would consider unleveraged scenarios versus leveraged scenarios. And so just like with capital budgeting, we would think about what is the most likely scenario, but here leveraged versus unleveraged, and then the best case and the worst case scenario. We would assign probabilities to all of our cases. Those probabilities, of course, have to add up to 100%, and then we would be able to estimate the overall expected returns to the different scenarios. And so it's that broader analysis that would allow us to take our focus off of just what the increased returns might be because of leverage, but consider whether or not the risk that comes with that leverage is worth it.